Stanley Druckenmiller is a trading legend. Over 3 decades, he generated on average 30% returns per year. But he recently put out one of his most controversial pieces of advice. It's a piece of advice that contradicts some of the most basic principles in finance and in trading. But it is also a piece of advice which has generated very high returns for many traders I know. So in today's episode, we're going to be breaking down the exact piece of advice, the pros and cons, and how we've also applied it in our own trading journeys. Let's get straight into this episode. Stanley Druckenmiller had one piece of advice that you need to hear. It goes against most of the conventional financial and trading wisdom. And in this episode, we want to discuss the pros and cons of that advice and also from our own personal experiences. Luckily, Pedma and me both have quite different, views and also applications of this. And we've also seen it work. We've also seen it not work. So Pedma, do you want to get into the one piece of advice that he recently put on Twitter?
Yeah, so the quote is something around put all your eggs in one basket and then watch that basket very carefully, right? And this is an interesting one because I think there's two ways of viewing this. So for an inexperienced trader, investor, whatever, you do want to add that diversification, right? Because you don't know any better. Like you don't really know if this investment is a good investment. What are your blind spots? What are you not seeing? All of these factors that contribute to a good trade, you really don't know. So your safest bet is always, okay, let's take this basket and diversify as much as possible so that you can, like, even if one or two are wrong, you still can capture the returns for that market or whatever from other assets. But at the same time, which comes to this quote, is that, yeah, sure, diversification will add that protection, but I do think that protection always carries a cost, right?
Sure. I think there's a couple things you're kind of missing around it. Is that one? I think concentrated bets is a skill you only get after many years of trading, and I'd also say like years of like profitable trading for the most
Yeah.
part. Because as you're saying, if I was getting straight into trading, right, and let's say in this context, right, we're doing some sort of swing strategy, right, and we're doing like concentrated bets in that way, I think that is a very dangerous thing to do, especially when you're very new, because you've barely seen any events, you've barely went through any drawdowns, you've barely seen what even a good concentrated bet looks like, all those sort of things, right? So I would say it's something that comes with more years in trading and also like more experience and skill. But then there's the whole other side of it that concentrated bets is quite a difficult thing to one even backtest for / kind of prove that you could even be right with it. And I think a better way of viewing concentrated bets is if there is a very big underlying inefficiency or reasoning or whatever way you want to look at it, primarily like an inefficiency that you can exploit and think, that's the place where you want to put most of your capital into exploiting that. So like this could be from anything from like a fair value play, right? Like you think something is mispriced and you think it's undervalued and you've modeled that out and you fundamentally think that, right? That can be a great way to put a concentrated bet on. And it's not so much that you're picking a stock just because you like it. It's something that you understandably have to know that there's this X thing that you're taking advantage of, for example. And that comes around the other point that those sort of opportunities don't come around that often. So for the most part, I would say diversification is better, like 90% of the time. Because one, if you're trading multiple strategies, for example, then you get multiple different exposures. You get exposures to different markets. And also for some things like taking advantage of trend following, you have to have diversification. If you don't, if you're only concentrated, let's say, on one particular ticker, that isn't a very good way of doing trend following for the most part. You get those returns by adding multiple different tickers and even multiple markets because you don't really know what's going to trend at the end of the day. So having exposure to multiple different things can be a very good way of doing it. I do agree in one sense that it's not the quickest way, let's say, to get huge outsized returns. Diversification, as you're saying, you have to pay a price, and that's normally going to be that you're not going to get as much return as what other people would, but you're probably going to get a somewhat better risk-adjusted return, at least on average, compared to all the other people that are trying to do concentrated bets, right? But I would say the huge benefit of concentrated bets is when you do see it and when the time is right, that's where you can make the majority of your money. I was actually just listening to August LeBron. Is that how you say his name? Is it LeBron? Or?
I think so.
Okay, that sounds so weird to say it's August LeBron. But one thing he was saying is there's like type 1 and type 2 opportunities, and type 1 opportunities are things that are going to pay the bills. It's primarily like risk premiums, right? We've talked about this on many other podcast episodes if you kind of want to look into those. And then type 2s are the ones where you're going to make, huge changes to your life or wealth. But the downside of that is those type 2 opportunities are very fickle. They don't happen that very often. And two, they can also be very difficult to even discover or understand or see that they're at play. So that's why I wouldn't ever say like quit everything you're doing and only look for concentrated bets. I think, ironically, a diversification of concentrated bets and diversification, I think, is normally the better approach. What do you think?
Definitely. Like I was thinking as you were saying that I completely agree, and we are not here talking about like I was not making a case for like running a trend following model and then like putting a much more risk on one trade or another. Like you should, like if you're trading trend following, usually you should scale your positions. If the trend signal is larger, you put more size. If it's lower, you put less size. That's not what I'm saying. But outside of trend following, let's say you get an opportunity. Let's say that tomorrow next year there's a bear market in crypto and Bitcoin goes down 70-80% again. How can I say this? There's almost there's almost a missed opportunity if I don't take an outsized position into that, I look back into 2022, what I'm going to do. Like imagine that you have a 100,000 portfolio, okay? And you spread your bets. Usually you have an average of a $5,000 position on your trend following model. You usually have 20, 30 positions at one time, okay? Now you see Bitcoin, you're going at 70 or 80% down. Are you also going to put $5,000 into it? It seems irrational to me to do that because it's such a discount. Sure, it can go to zero, right? It can go to 90% down. It can go to 95%. What I'm saying is that the upside potential is so large that taking a normal size position in something like that seems that you are leaving a lot of money on the table. Now, the caveat, like you said, how do you determine that trade has that upside potential? And that comes with experience, with experience and the intuition to put a bunch of data together and to understand what kind of risks you are putting on the table, right? I'm not saying to go 50% of your portfolio into one thing. That's not what I'm trying to say. What I'm saying is that when those opportunities present themselves, that seems almost like picking money off the floor. It seems kind of inefficient to just put like 1% risk of your capital in there, if that makes sense.
Yeah, completely. I think actually one thing I wanted to touch on, and then I think we should get into giving maybe an example of these concentrated bets, is one, the common thing I've noticed with concentrated bets is often timing is going to be the very difficult thing to match, and often it will be wrong for longer than you think. It will often take longer drawdown than you might expect. So those concentrated bets, while yes, you need to maybe allocate more capital to them, as you're kind of saying, maybe with BTC, right? If it drops a lot and you are fully convinced they will return based on X factors, it's most likely you should still be appropriate with it, not like leveraging 100x to try and do that trade, right? Like that's not going to make sense. Most likely holding it in spot or having maybe a very small amount of leverage is going to be the better approach while it's still being a concentrated part of your portfolio. And then second, I think a great example of a concentrated bet that I'll say I missed, I wish I had taken it, but was the MrBeast kind of fundraising trade on Polymarket recently. That is a great example of something that is fundamentally inefficient. It's still, a bit discretionary. You can't really model it. I guess there's a couple of ways, but for the most part, it is a bit discretionary on a concentrated bet. And it was primarily around MrBeast did a fundraising. I think it was 40 million for it was 2 years or 100 years or something of water aid to different countries. And it was being priced on Polymarket on if he's going to complete it by, I think it was August 31st. And at some point, I think it was priced at 20% and then even at 40%. That is an incredible concentrated bet that depending on how much liquidity and, allocation you want to put, you could get a 40%, extra return on that. That is, well, like almost, I guess, a 2x return on that, which is an incredible place you could do a concentrated bet if you were looking for those sort of opportunities. But as I kind of mentioned before, that's a very rare opportunity. That's not going to appear every week or every month. That's maybe once a year sort of opportunity.
Exactly. Exactly, and that's the exact thing that I'm trying to get at, is that these are not trades that you do systematically, that you come here every day and you take a position or something. No, those are reserved to my risk premium harvesting type stuff, like momentum, trend, whatever. But there's opportunities that these trades will be on the floor for us to pick up. And again, it needs intuition, it needs experience. I want to make that very clear, because you are not going to go and see sheep down 70% and say, oh, I'm going to put my portfolio. That doesn't make any sense. But when you see something that is clearly mispriced and you have some basic model around it, you can. I tend to take outsized positions in that, and a lot of my returns for the past year. No, I'm going to say the majority of the returns for the last year has been for me on those type of concentrated bets so far. Now, it could be again a case of getting lucky, a case of the plane, that picture of the plane that survived. Hindsight bias. But like Druckenmiller said, like sometimes it's good to. He likes to put all his money in a basket and watch that basket very closely, and that has been the theme for my year of trading, for my last year.
Yeah, I'd also say this can apply in a systematic measure of, like, let's say, I wouldn't apply this to strategies so much, but let's say you had an arbitrage opportunity that presented itself, or something similar to that, right? That could be exploited in a systematic way, and you've seen it work live. You've tested it well. That is a case where maybe I would take some of my normal allocation to risk premiums and move that to that allocation and give it a bigger percent of the portfolio, because things like that aren't going to last that long, and you can make a lot of excess returns from those. So it can also apply to systematic opportunities. The only caveat there is I wouldn't really apply it to strategies. Maybe there would be a case of applying to strategies in the sense where, let's say you have a really great OTC strategy, but that OTC strategy only really works in high momentum sort of markets, and think of 2020, 2021. If something like that appeared again and you had metrics to kind of gauge that, you could definitely increase your allocation to that sort of strategy and try and exploit it as much as possible during that time. So it does apply there, but I think the hard thing with concentrated bets is inherently it is a bit more discretionary. It's quite hard to model, because most of the time the best concentrated bets, there's not that much data on. So that's just kind of how you have to view it.
Yeah, that example that you just gave of the arbitrage opportunity, I think it's the perfect example, right? It's the purest type of example. It's like you see something that is mispriced, that's exaggerate, but that's mispriced 20% on one exchange versus another exchange. Theoretically, you want to take as much as you can in that. You want to borrow the house against it if possible, right? Because it's clean money. It's taking from one side and put it on the other, theoretically. We'll not talk here about idiosyncratic risks. So that's the type of opportunities that arise once in a blue moon. But if you are there, I don't see why you would see like a 20% mispricing between two exchanges and you would take 1% risk. Just to say 1% risk doesn't make any sense, right?
100%. I guess then, if there's anything else you want to talk about, but the last part I think we could discuss was just sort of our outlook for the FOMC coming up, because I think that's going to be a major event for everyone. All right, cool. I think, in my opinion, I agree with the Short Bet did a great post around it recently. He was basically saying that it's going to be sort of a similar situation to buy the rumor, sell the news, right? And if you've been around and trading for a while, you'll notice that this sort of trend really does replicate in everything for the most part. Most people buy anticipation, and then once that anticipation or thing has been confirmed, there'll normally be a sell-off for people unallocating to that particular asset or X thing. And because the markets are forward-looking, that's kind of a natural dynamic of it. So I am more on the agreeing side of that there will be a nice rally into FOMC, because now I think it's being priced at 100% that rate cuts will happen. Now, I will say there is a huge danger here that if rates are not cut, it will be the craziest drawdown, I think, in a while. But I do think the probability of that happening is very, very, very low. But I would probably be buying into the kind of rally into the FOMC day, and then normally probably sell off the day before or just on the day of FOMC. Now, obviously, that doesn't mean I'm selling off all long-term positions. I'm completely exiting the market. I think it's just more that I'm maybe taking some extra allocated risk during that time and then taking it off when FOMC basically happens. What about you?
Yeah, front running that flow, right?
Yeah.
I completely agree with you. Markets are for again, we are not here macro traders, right? It's just my opinion, my uneducated opinion. So markets are forward-looking machines. You are not going to the market, real money, real institutional and smart, what's called like smart money, is not waiting for Powell to say, oh, rates are cut. No, they are already positioned. You understand that, right? It's markets position themselves based on probabilities of future events, not on the event. Unless something completely random happened that nobody could predict, that creates volatility. Otherwise, like it's a sell the news kind of things when it happens. Now, does that mean that a market will crash? I don't think so. I do think that lower rates bring more money into the economy, into the people pockets, because people don't have to be spending on their mortgage so much, on their credit card interest, whatever. So that's money flowing into the economy again. We just have to see what happens after. If economy continues to be soft and stuff like that, then there's other issues around that. If that happens, so it's all an if-then scenario. My outlook it's more into 2026. Like I've been saying for a long time, into 2026, I don't want to have large allocations to discretionary long-term backs, if that makes sense. Those concentrated positions we just talked about. I'm not feeling very good into late 2026 to have those positions anymore.